You built up a 3.1% stake in Deutsche Bank back in November 2018. You're the second biggest shareholder right now. You had said early on that you thought Christian Sewing was the right man for the right job at the right time. How do you grade this restructuring plan announcement?
Well, I actually give it an A because Christian has done, quite frankly, more than many had hoped he would do. And I'm going to break that down into 4 different components. The first is, at its core, this is really not a restructuring. This is a repositioning the company and change in their strategic direction. And all of the other components of this plan are going to flow from that. And what Christian is taking the bank back to is its 150-year-old history of being one of the world's best commercial banks. It's consistent, it's stable, it's a little boring, but as an investor, that's an exciting place for me to be. And then he's doing 3 other really important things. The first, he's cutting back the investment bank to really focus on its core strengths and the places where it has competitive advantage, and that's really built around the fixed income businesses, the credit businesses, the FX businesses that serve those million corporate clients that are going to be housed in the commercial bank. The second thing he's doing is he's making the bank much more efficient. And people are struggling with that. They're saying, how can I raise revenue 2% a year but cut my costs at the same time? And what the market hasn't quite come to understand is of the $6 billion in restructuring, $5 billion is comprised of businesses they are exiting in this CRU, and $1.4 billion in incremental merger savings from the post-bank Deutsche Bank merger that's been anticipated to be executed on. So this is really comparing apples and oranges, but he's digging deep into that efficiency. And let me just share the third thing with you, which is he is changing the liquidity profile, the leverage ratio, and the capital deployment of the company. And ultimately, he's going to be running off 20% of the balance sheet. He's going to do that in the next 18 months, liberate capital to make the changes he needs to from a restructuring standpoint, and then this company becomes a generator of capital to return to shareholders, which is what I'm most excited about.
This is an enormous change that he's making.
Yes.
And you're seeing the reaction today by investors. Obviously, this is just a one-day reaction.
Sure.
We know this is going to be a process. I guess I wonder, was there another way to do this? Another way that, at least in the interim, may have maybe preserved a little bit more of the wealth that was out there for investors? Or was this sort of necessary to just rip the Band-Aid off and do it this way?
Yeah, you know, it's interesting. So he's been CEO for a reasonably short period of time. Mm-hmm. And the challenge he had is that the bank had been on a strategic path for the last 20 years. And it found itself in a very difficult position. Now, he inherited a clean balance sheet, liquidity, and the ability to actually make this change. And really what's happened over the last 12 months as he's come into the job is he evaluated an alternative transaction which wasn't as good for the shareholders, and he's really refined his thinking around this new set of strategic agendas and priorities for the bank. I actually think we'll look back at this as a really wonderful case study in a new CEO resetting the agenda for what is a globally important company, and I'm quite excited about it.
Resetting the agenda, one that does not include teaming up with another bank. For a while, there were reports that Deutsche Bank and Commerzbank would merge. I didn't hear you talk about any kind of partnership or any kind of M&A. Is that out of the picture now?
Yeah, I think appropriately so. You know, one of the things, I worked at JP Morgan for a long time, and I think one of the interesting questions when Jamie got to the job was, what are you going to do in the merger of JP Morgan and Bank One? And he said, well, I'm going to finish the merger of JP Morgan and Chase first. In order to be an effective merger partner, you have to be running your businesses efficiently. And I think Christian's focus on improving the business that he operates today, self-help to create value, will put Deutsche Bank in a much stronger position in the years to come. And it is inevitable that there will be further consolidation in Europe. There'll be further consolidation in Germany, but you want to do that off your front foot, not your back.
From a position of strength.
From a position of strength. And I think this plan given time, is going to create that position of strength that really is going to make Deutsche Bank one of the preeminent commercial banks in Europe and in the world.
So when you look at, though, the industry as a whole, I mean, coming from J.P. Morgan, which arguably was sort of built into an empire, that was sort of the intent, at least from the outside looking in. And then now we're looking at the direction that Deutsche is going. Is the general idea here that that sort of mega bank where you had to be on the investment banking side, you had to be on the trading side, you had to be on the commercial banking side and have this all under one umbrella, is that model, is that necessary to thrive the way it was thought to be?
Yeah, so it's great. It's a great question. Yeah. And I would say, think less in universal terms and think about, I want to be in businesses where I have sustainable competitive advantage. JP Morgan is a spectacular company. It trades, by the way, at approximately 2 times tangible book value. And it is competitive in each of the businesses that it operates in. Deutsche Bank doesn't have to be JP Morgan. And one of the challenges with the last 20 years is it didn't have the wherewithal to do that, but it tried to be competitive. And what Christian is saying is, I can be very effective as a commercial bank, serving my corporate clients, a wonderful private bank in Germany, and an asset manager. And I can do those things and have competitive advantage, and that will generate a very attractive return. So think not JP Morgan, think BNP, SocGen, HSBC. And Deutsche Bank needs to peer with those businesses, and they can be and will be, with the tools they have in place, be very competitive and effective there.
At the time that you built your stake, you said you didn't want a supervisory board seat.
Right.
That remains the case. What would make you change your mind on that?
Well, you know, honestly, I've had a wonderful dialogue, an ongoing dialogue with both the supervisory board members and, more importantly, with the management board members. And to me, it's all about engagement in the most effective way for the set of circumstances. And quite frankly, I feel like my dialogue with Christian, James von Moltke, Frank Kuhnke, the senior management.
How often do you speak to those guys?
I speak to them enough to know that what they're doing today has been very, very well thought out, well planned, and given time, I have a high degree of confidence is going to be very successful for the shareholders.
When you also took a stake, that stake that was made public back in November, you also cited the potential benefit of rising interest rates. And a lot's changed since then. And now we're looking at a world where we could be talking about declining interest rates.
Yeah.
Can savings sort of navigate, I guess, a world where maybe this is sort of that lower for longer environment that a lot of people talk about?
Yeah, so it's interesting, and that was clearly part of the option, and over time that still remains part of the option. What I like about the timing of this plan and the particulars of it is it actually builds from a lower for longer environment. So we're taking the most challenging environment banks are in from an interest rate standpoint, and that is literally the foundation from which the strategic repositioning occurs. So it will work effectively in this environment, and that's the plan that's been put in place. I think it's quite conservative. Having said that, the opportunity to accelerate that certainly exists if the environment changes. But as you said, you know, it's tough to bank on that today.
Yeah, hard to see where that's headed. So clearly, you're happy with your investment. At what point would you be so happy that you'd be ready to complete it, to close it out, to exit it?
Yeah. So I am a value investor, and as such, I think you have to have the patience and time, because when I bought the company, a lot needed to change. I think this is the first critical, seminal step along that way. Here's the good news for me. The stock today is 0.25 times tangible book value. The European peer set that I mentioned trades about 0.8 times tangible book. The US peer set, 1.2 to 1.4, and JP Morgan, as I mentioned, at 2 times tangible book. There's a lot of upside before I get to the point where I think they're trading as they should be, which is, quite frankly, one of the very best commercial banks in the world, headquartered in one of the best economies in the world, with a wonderful consumer franchise. So I've got lots of room to run and a long time to do so.